Good day, investors. Today we are looking at another British tobacco company, Imperial Brands. So it produces tobacco and vaping products, simple business with cash generative properties. They are shifting toward new products, but they are really slow on that. More on that later. They have strong brand loyalty, although less than their peers. Nicotine addiction and regulatory barriers for new entrants help them to keep their moat. Management is focused on debt reduction, dividends, buybacks, and efficiency. I estimate intrinsic value on £39 with strong profitability, stable business, and manageable debt. On the meaning side, it produces tobacco, cigarettes, vaping products, and new products, and we will see more on those later. Simple cash business, facing declining cigarette demand and tough regulation. Although, since their price inelastic, their business, meaning prices go up by 10%, demand only falls around 4%, so that's a 0.4 price elasticity. They can get more profitable with less volume. And they have a limited success so far with the next gen products. They have a large whale, Canadart, who I mentioned at the BAT and Evolution video. He owns around 9% of BAT and 20% of Evolution. He owns around 7% of this company. He started with 3%, today it's 7%, so it's a good uptrend. He targets undervalued high cash businesses that the market dislikes and encourages disciplined financials, followed by dividends, buybacks, and debt reduction. So you can see him here. And if you want to look at the other shareholders, pause the video and take a look. I think Canadart is worth mentioning. On the segment breakdown side, you see they are heavy in Europe, and also you can see them in the Americas, and this is basically an other bucket. You also have Central Eastern Europe in the other bucket, so maybe you could move it here, then Europe is even higher than 41%. On the net revenue side, so this is not profit, net revenue, you can see that basically a small fraction, 4%, is coming from the next generation products, NGPs, and most of the net revenue is coming from traditional tobacco. I would like to mention that this is net revenue and not even profits. Usually tobacco is really profitable and the new products are not. So I would suspect they have almost 100% of their profits coming from tobacco. On the Moat side, I only recognize in a non-smoker Davidoff, so that ties into with they have brands, but not as strong as competitor brands like BAT or Philip Morris, whose brands everybody kind of recognizes. But still they have loyalty, nicotine addiction going for them, strong barriers to entry from regulators, and they have a strong distribution channel. Pricing power, because it's a tobacco company. Even if you have a dropping volume, you can increase prices and offset and increase profits going forward. On the management side, they focus on debt reduction, dividends, efficiencies, buybacks. So this is Canadart's impact on the company. We will see numbers on the next slide. And they are driving simplification and sticking to core markets, right? So there is this company dynamics you can see, not just here, but for multiple companies, that they want to spread out, decentralize, then they want to go back, focus on core markets, re-centralize, and then a couple years pass and they decentralize, re-centralize. So you will see these dynamics. They are in the phase when they want to simplify and focus on the core margin producing areas. They have a progressive dividend policy aiming to sustainably increase year over year. Last year, they increased 4.5%. If you look at management incentives, everything ties together. They have really nice incentives. They want to focus on, this is annual bonus and this is long term. So let's start with the short term. Operating profit growth, great. Cash conversion, great. Market share, great. ESG, whatever, they have to put it in there. Strategy per individual. Okay, long term you see EPS growth. So this is crucial because if you increase, and we will see numbers on that on the next slide, if you see 1% increase in profits, but you also reduce outstanding shares by 1%, suddenly that's a 2% increase earnings per share. So this is really important, and you see this is 40% of their rate for the long term. So they are really incentivized to do buybacks. You see they want to keep debt under control. They want to focus on stuff that actually make money, so invested capital, and overall in the end, relative total shareholder return. So it's your share price and your dividends. if you are doing everything right, your share price should increase. And looking at remuneration history and the debt, I want to start with the debt. Peaked in 2019. Today it's around below 150 debt to equity, which is high, but not for a stable business like this. And we will see the details on the next slide. So debt actually came down. You see that free cash flow on the green was at the bottom in 2021, exactly when Kenneth Dart jumped in. So when he jumped into the business, since then he's been enjoying the free cash flows going higher. And you see in the past 2 years, buybacks were really picking up, even from previous years when they didn't do much buybacks. They are doing lots of buybacks now. If you would look at the share price of Imperial Brands, they did quite well in the past 2 years. They actually reduced shares from 2018 to today by 9%. So that's great for the EPS growth. And they are paying nice dividends. So if you add up, let's say 2024, 2.9 billion pounds free cash flow versus 1 billion plus 1.3 billion, so 2.6 versus 2.9. So basically they are paying out most of their earnings, free cash flow, to shareholders. On the margin of safety valuation perspective, I believe this company is worth around 39 pounds per share. I used a 10% discount rate. I used a 2% growth rate going forward to get to this number. And I also compared it to what if I just look at 24, what if I average out the last 7 years. You see that I'm kind of in the ballpark, and that's a crucial part to value businesses like this, is that a lot of businesses get mispriced because you estimate a 15 or 25% growth rate. And if you expect 20 and it actually only 15, you are off. Especially if it's maybe 10, you are way off. But a company like this, they are not growing as fast, so you cannot really misestimate the growth. They are very profitable. So if you look at the return on equity is high because they have not much equity. Return on investment is okay. But what I really like to look at a company with brands like Coca-Cola, Philip Morris, BAT, these kind of businesses, is you want to look at their return on tangible assets. So that return on investment is return on all of their assets. Return on tangible assets is return on all of their tangible assets. So you get all the assets minus intangibles. What intangibles these kind of businesses have are brands, goodwill, the softwares, these kind of, they basically don't need much stuff to run the business. And actually that's actually ties back here in this chart, is they have really small capex. So if you look at capex last year versus operating cash flow, you see that almost 90% of their incoming money stays as free cash flow because they don't have to spend a lot of money to keep the operations running, right? They are not like a railroad where you have to maintain the rails, otherwise everything collapses. So it's really good. It's a really strong cash business. Return on tangible assets really decent. Their debt to equity is high, but because they are a more stable business, it's not really an issue for them. They can manage this debt. And it's not just debt to equity, but basically it comes down to your coverage ratio. How many times can you pay your interest payments out of your earnings before interest? So they have 8 and they averaged just below 7, so they are fine. Their cost of debt a bit higher than it used to be because interest rates went up since the lows, although they are seemingly coming down going forward. And there you have a current ratio of 71.5 from 76 over the 7 years. This is okay because current ratio is your current assets minus divided by current assets divided by current liabilities. What that means is they cannot cover all their current liabilities, but it's actually not that simple because they have cash generative business, so they have assets coming in, going out. They don't have to stack up a lot of cash like an oil or a gold company would, which are really cyclical. They pay 6% dividend, but if I go back to the previous slide, that 6% is basically that 1.3 billion. Their free cash flow yield is more than double that, so it's like 12-30% free cash flow yield against this dividend, and you also get the buyback. So basically you have a nice 10% return already. and they keep some of the free cash flow so that sooner or later will be yours, or they're gonna use it for the company to make it more profitable. So in short, strong, stable cash flows and reduced debt. Perfect. They offer downside because of the stability of the business, although they have limited growth. So that's kind of the offset you have to deal with. I added a summary from Buffett principle perspective on the meaning, understandable, cash flow, limited growth, ethical concerns, right? This is a tobacco company. This is also one of the reasons why it's more attractively valued, because lots of insurance companies have ESG policies against tobacco, so they don't invest. Hence, less buyers are coming in for these companies. Therefore, they are cheaper for you to buy and get a nice return. From the Moat side, brand loyalty, addiction, regulation, perfect. But weakening versus peers, they have not as strong brands and they are falling behind on the new categories. Management is improving discipline and focus, but mixed historical record. What that means is they were slow to the game on new products. By the time everybody has profitable new products, they might not have yet, so they are kind of behind on that. And they had large debts that they are turning around from. Canada Dart is a good 2021 entrant, and going forward we can hope that we have a large whale shareholder who can push the interest of basic shareholders. Margin of safety side, it's an attractive business. It's relatively cheap, especially if you look at US companies as comparison, but also European. 6% dividend yield, and if you look at the chart down below, Imperial Brands, they have around this one, 12% free cash flow yield. So that's really decent with a stable and low volatility business. I see an upside at 31% if you want to earn 10% free cash flow yield going forward at this rate. So you have a margin of safety to buy it. You can use a higher or lower discount rate, and then that changes for you. But that would be it. If you enjoyed this video, please like and subscribe, and let me know if you have any companies on your mind. Thanks, guys, and take care. See ya.